viewers, I'm here to share with you about my stock account and market updates. Today we're going to be talking about the market sentiment for the US government bonds, neglecting how Finch downgraded the US government bond earlier last week. The investors still have a positive optimism towards the US government bond, and according to us, was a survey conducted by Boss. 60% of participants said it is a good time to buy the US Treasuries with maturities longer than 10 years. Even though there will be a higher chance for the US government to fail to pay back the bonds. And 59% of responses were made before Fitch downgraded its U.S. rating on August 1st. The U.S. stocks, they also shared about their sentiment for the market. The U.S. stocks soared in the earlier half of the year due to the bubble of AI technology, dragging Nasdaq 100 up nearly its highest rise for the first half of the year in history. The majority of the respondents to the poll survey, 47%, said the U.S. stock market is a bubble, fueled by irrational exuberance, and a quarter believes that the U.S. stocks are in a bear market rally. Meanwhile, only 28% believe they are currently in a bull market with a more upside. More than two-thirds of respondents said the S&P 500 is in a deep earnings recession and that it'll last longer. The survey also showed that investors believe the U.S. inflation will remain high, highlighting the complexity of macroeconomic risks. Nearly three-quarters of respondents expect core inflation, as measured by PCE, the Fed's preferred measure of inflation, to either remain above the 3% over the next 12 months or rebound below that level. The indicator currently stands at 4.1%, the lowest level since 2021. This suggests that many expect a severe recession in the U.S. economy at some point, and that the Fed will ease policy even if inflation remains high. Because of this, investors are worried about the outlook for the stock market. Mayorsk said the global trade could shrink for longer and longer than previously thought, lowering the global container growth range to -4% to -1% in light of continued destocking. Maersk, the world's largest container ship owner and global trade warned that global trade has shrunk longer than expected. European and American demand is declining, and there are clouds ahead. On Friday, Maersk released its second quarter earnings, with revenue falling 40% year-on-year to $13 billion, of which shipping revenue fell by 50%. Maersk CEO Vincent Clerc said in an interview with Bloomberg that container shipping industry is the biggest adjustment period after the pandemic in 2021 and 2022, and that global trade may shrink longer and more than previously thought. The inventory adjustment appears to have been extended since the fourth quarter of 2022, and is now expected to continue until the end of the year. Based on continued destocking, Maersk believes that global container growth ranges from -4% to -1%, compared to -2.5% to +0.5% previously, and ocean freight is expected to keep pace with market growth. Bloomberg analysis pointed out that Maersk's second quarter results remain generally stable, but long-term inventory adjustments, recession risks, and expectations of a weak freight volumes overshadow its future results, which may affect the company's financial position in the coming months. Lower freight rates combined with lower new ship deliveries and disposal income are likely to deteriorating financial indicators in the second half of the year in 2024. It is worth mentioning that container ship industry relies on global demand trends during the 2020-2022 pandemic, as retailers and other companies replenished inventories to meet pent-up consumer demand, and the container shipping industry ushered in an unprecedented boom with a shortage of containers and rising freight rates. However, since the beginning of 2022, container freight rates have been falling sharply, and the global central banks have adopted monetary tightening policies to curb demand-induced inflation. Although container freight rates have increased recently, this does not seem to be a sign of global economic recovery, whereas as the impact of declining vessel capacity. That's all I have for today. Thank you for listening. Don't forget to subscribe and see you next episode.